This next panel is going to be on the outlook for the Canadian economy. I've been coming to Canada for a little bit over 2 decades now, on and off, and this is, I think, a great time to be having this discussion because this is really a period of flux for the Canadian economy. It's going through a lot of change, a lot of disruption happening at the moment, some of it negative, some of it positive. Periods like this, it's during times like this that the next great companies are born. It's during these times of disruption and change, and there are opportunities here as well. So we've got a great panel to have this discussion with, some very distinguished speakers who are very knowledgeable across all of these topics. First of all, I'm going to spend 5 minutes or so just setting the scene and talking about what the Canadian economy looks like right now and what are some of the major factors that are driving it. So this is quite different to when I was here a year and a half ago at the last Canadian summit that we had, and we were talking about Canada as the leader in the G7, the country that had enjoyed the fastest growth since the financial crises. Everyone was looking to Canada to see what they could replicate. And the last couple of years has been much more difficult than that, and this is one of the major reasons for that. So instead of being the fastest growing country in the G7 now, Canada is set for its second year of growth below 2%. And outside of the financial crises, that's the first time that's happened in over 2 decades. So it's a difficult time for Canada, but there are several different competing factors here. The major difference from when we were having this discussion a year and a half ago is the oil price. And this has been a curse for a lot of parts of Canada, but it's been a bit of a mixed blessing as well for some parts. So the plunge in the global oil price obviously hurt the energy sector instantly. We've seen a fall off in investment. We've seen layoffs in the energy industry, and that has spread to other sectors that service that sector as well. However, lower oil prices has been a boon for consumer spending, not just in Canada, but around the world as well. So when consumers have to spend less money filling up their tank with gas, their heating bill falls over the wintertime, it leaves them a little bit more disposable income in their pocket for spending on an extra meal out, some new clothes perhaps, and so that has supported the retail sector in Canada over the last while. One of the most beautiful things, I think, and people rarely refer to my charts as beautiful, but to me this is one of the most beautiful things about the Canadian economy, is that there's this natural shock absorber here for when the oil price does fall, and that the currency follows it down. So there's a couple of factors driving the currency down over the last couple of years. You've got the interest rate differential with the US as well. But the oil price is a major component of this. And you can see that very tight correlation between the oil price and the Canadian dollar. And that's great news for a lot of parts of Canada. So that's instantly makes Canadian goods and services cheaper abroad, and it's been fantastic for exports. So Americans are buying more Canadian goods and services. Europeans, Asians, around the world, Canadian exports have instantly become more competitive. It's also a boost to the Canadian tourism industry. So you have a lot more Canadian tourists, or American tourists rather, coming here. I imagine this hotel has seen an increase in US visitors over the last year and a half. So the oil price fall, I think the headlines tend to focus on the negative, and overall it is a net negative for the Canadian economy. It has dragged down headline growth rates, but it is also a positive and an opportunity for different sectors of the Canadian economy. So that's the major story over the last year and a half. The other major story, and this has not gone away, and it seems to have enjoyed a bit of a resurgence over the last couple of weeks in terms of media attention, and it's going back to the property market question that Matthew just asked Bill about, and this is Canadian household debt, and this is worryingly high, and I know that we've been saying this for several years, but it's still true, and it's still very pertinent. So what this chart shows you here, the blue line is Canada, and the red line is the US. And this tells you 2 stories. This is household debt. Canada didn't go through a tough time of it compared to most of the rich world countries in 2008, 2009. It had much more sensible lending policies in advance. It didn't have the property crash that everybody else went through. And that's why the Canadian economy enjoyed such strong growth in 2009, 10, or well, in 10, 11, 12, compared to the rest of the developed world. However, that was, again, it's a bit of a mixed blessing, because what the US did is it went through this big deleveraging cycle. So you had a lot of property foreclosed upon, a lot of bankruptcies, And consumers spent a lot of their income paying down their debt. So when you think about it, there's three things you can do with your income. You can spend it, you can save it, or you can use it to pay down debt. And a lot of the rich world countries, consumers were forced to pay down their debt because their property value plummeted, they were in negative equity, yada, yada, yada. And so here we are now, where that was a very difficult time for the US economy, but now it's benefiting from that. So US household debt levels much lower now, whereas Canada sort of coasted through those years, and now household debt is incredibly high here. And the danger, the big risk here for the Canadian economy is that you have a negative external shock. You have this sort of oil price slump that we've had over the last couple of years, and that pushes up unemployment, and it makes it more difficult for people to service this debt. And that's the danger that we talk about when we talk about a possible housing bubble. This is where it would filter through to the economy. You could get a lot of defaults, and that's a major concern, a major worry. Ideally, what you'd like to see is credit growth taper off a little bit, and for other parts of the economy to offer more support. So more from business investment, more from exports, more from the government, and less of a burden placed on consumers to power the economy. So my final chart, and this just shows you these trends. The blue bars there are consumer spending. So a lot of that is predicated on household debt. And so that the potential there is not much higher than what it's been doing over the last while. So the Canadian consumer cannot bear too much of the burden for future growth in Canada. That green line, negative, that's the oil price story, really. That's business investment. And that is that very large contraction in business investment in the energy sector over the last 12 to 15 months. But what you can see, the story that this chart tells, those green lines are getting smaller. So a lot of that contraction has been done at this stage. And so you can see a gentle upward and almost at a stagnation in business investment. And that, I think, that very difficult story in business investment over the last couple of years is tremendously difficult for any economy to absorb. And I would say it shows the resilience of the Canadian economy, that it has, in fact, done relatively well with such plunging business investment numbers. And the final bar, the red one across there, shows you export growth over the last 15 months or so. And that's what we're looking to for the future. That's what the cheaper Canadian currency should help, is Canadian exports. And so that's that natural shock absorber that we talk about. When the oil price falls, business investment falls, but the currency falls as well, and that should benefit Canadian exports. So that's my sort of few very brief talking points about the overall picture for Canada right now. I want to spend the next 30 to 35 minutes with our panelists talking about the future. What is in store for Canada over the next year or two? I want to just start off this discussion by talking about the global economy for a moment, because Canada has endured a tough couple of years, but this is one of the worst years that the global economy has had for quite some time, and there's a lot of countries around the world struggling, emerging markets not doing very well, China, fears of a slowdown there, but Europe and the US as well, not reaching the sort of growth rates that we saw a decade ago before the financial crisis. So, Jean, I'm going to come to you and just an easy softball opening question. What on earth is happening?
Well, I'm not sure if it's that softball, but let's start there. I think I would make just 3 points to start. The first one is we see this recovery and where we are. Basically, this is part of a long and flat cycle, modest growth, and what we should expect after like a big financial crisis like we've been going through. So if you look at the track in the US, it's basically following the script of a post-financial crisis. It's not a strong growth, but it's not that much weaker than you would expect. And I think there's more to that recovery to go. And that's something that is difficult, I think, for collectively to grasp. It's been 8 years in the last recession. We tend to think of the cycle we've seen in the past, but we think that this has longer to go as a broader recovery. But for that to happen, we need some reflationary dynamics in the US to really get entrenched and to get to the next stage. So that's one point. Second point is, I think this year there's been big changes. So we have a bit of a gloom and doom starting point here, but there's been big changes over the last 6 months. Oil has stabilized, so that was the big story for Canada, but we've stabilized oil, now we're around 50. That's a huge deal for Canada, but it's a huge deal, I think, for the world as a whole. I think it played in many ways through the global economy, but one way in which it played was in terms of feeding into the deflationary fears globally, which was beyond the benefit that you get from the consumer boost from that. I think another big change we've seen, we would argue that the fears of low inflation for long in the US are dead. We don't expect necessarily inflation to be very high, but we're in a world of 2%, close to 2%, and taking these fears aside is a big deal in terms of changing the dynamics potentially. So that's a new change this year. We've seen some EM stability, and we've reached kind of a sweet spot between, the dollar appreciation that has stopped. Overall, we've seen oil stabilize, and all of that creates some stability in the EM world. A big question going forward will be whether China becomes, the exchange rate question becomes back on the table, but for now this has stabilized. The last point I would say is, despite all of this, I think there is a real dynamics of fear around all of us going into a liquidity trap. I don't think that's the case, but it is a fear, and I think it is driving markets, and that's why we've seen...
What do you mean by a liquidity trap?
This fear that we are all becoming Japan, basically, where we're going to go in a world where it's low growth, low inflation, and policies get out of ammunition. That theme has taken a bit more hold this year. I think it's receding, but it's in a world where there's a real question around what policy can do in the case of a real slowdown. Those fears continue, and they are driving markets. From a market perspective, it's something that is already happening.
So you're painting quite a sort of a positive picture, I would say. Like that almost sounds like a turning point. Commodity prices stabilizing, re-inflationary pressure from the US, like generally quite positive, but running up against a barrier on growth because of demographics, because of this sort of Japanification across the world for rich world countries. Would that be a fair summation?
Yeah, so I think we're in a modest growth environment, and it won't, for all the structural reasons you mentioned, I think that has longer to go, so that's the kind of better assessment. But there are fears that if we were to face a shock, policy might be limited, and I think that is driving concern and fear even to this day.
Right.
But I think the point here is the new normal going forward for the world is 3%. It's not the 3.5 or 4 that we thought of as being the normal speed limit 15 years ago. Productivity has slowed down for reasons we don't fully understand, and we've got the demographic issue, and we've got the inevitable slowdown that's going to come in China as they make the transformation. So you got to think around 3% as being kind of normal. It's not bad. It's not somehow we're still in a recovery from the great financial recession. We're back in we're into a normal world that looks slower than the normal world that we thought we had back in 2000 or 2005.
So stop comparing it. This is what we should get used to. Stop comparing it to the past.
Stop thinking about it as we're still recovering. We're in a new world which has a lower potential growth rate for the world than what we had 15 years ago.
Jean-Marie, you've written quite extensively on this. What are your thoughts?
I would add 2 points to this. There are large parts of the world that are in really dire economic straits, and that is dragging down world growth. Think of Latin America, which is in a recession. You have Brazil still contracting last year at a rate of 4%, Venezuela in an even worse plight, Ecuador in a recession. You have Russia contracting also by close to 4% last year. You have entire parts of the Middle East, which are plagued by domestic and geopolitical strife. So there are actually large parts of the emerging market world that are underperforming to a very, very important extent. They may not...
How much of that is the commodity story? Because you've just gone through Latin America, Russia, the Middle East, all for the most part commodity exporters. Is that what's dragging it down there?
There is clearly a commodity story there, but it's not a pure commodity story. You can think of a lot of idiosyncratic country-specific factors. Think of Venezuela. It's clearly oil is playing a role, but the disastrous macroeconomic policies followed for a decade or more are clearly as much to blame. For Brazil, there is really a perfect storm of a domestic political crisis, the corruption scandal, the impact on investment, the Zika virus, the commodity price decline. So I don't think it is a pure, just a pure commodities story, although that is clearly playing a role. But my point was, yes, it is true, trend growth in advanced economies is lower. Yes, it's true, China should be slowing and is slowing, but I think there is still work to be done to boost world growth by just getting back to a more normal situation in large parts of the emerging world.
And how does Canada compare to the rest of the advanced economies that you just mentioned? So Canada versus the rest of the OECD.
Overall, I think Canada has done very well after the global financial crisis. You were referring earlier to the role of the exchange rate as a shock absorber. Clearly, on the upside, the very strong Canadian dollar, together with the fact that its main trading partners was suffering the aftermath of the most severe crisis since the Great Depression, clearly took a toll on Canadian growth. Canada would have, had it been in a different part of the world, had it been Australia geographically, it would have done much better. So part, I think, of the relatively weak performance in absolute terms relative to historical record is due to the fact that there were a number of external factors curtailing Canada's performance.
Right. So that leads us nicely into the domestic economy here and the policy mix, because you said that it was a lot of external factors that sort of have hit Canada over the last couple of years, but it's done relatively well. And I think the word that I've used to describe it most frequently is resilient. If you walk back 2 years ago and said, this is where the oil price is going to go, and you look at Canada's performance since then, I think most people would have taken that. So let's talk a little bit about the domestic policy mix then, and we've heard already this morning about monetary policy and fiscal policy. What are your views on the domestic policy mix right now?
So, I mean, just to build on your point, which I think is crucial, I mean, if you look at the Bank of Canada forecast in April 2014, so that's before we knew about the extent of the decline we would see, and you compare it to the latest that they put out, they were forecasting 2.5% growth for 2015. We got 1.2%. So that's a significant shock. But if you had, I think, asked me, that's what we're going to go through, I would have expected much lower growth as a result, and I would have expected inflation to be much lower. The rest of the world has been grappling during that period with low inflation as a worry, and we were basically core inflation close to 2 throughout that period. And how did that happen? That happened because you talked about resilience. In practice, it means we had the export sector that provided more boost than we have seen over the last many years. So that was a key development. We've seen the housing sector contributing 0.5 percentage point of growth in a world where we were already questioning where this housing sector was. Yep. And consumption has been basically stable. So that's good news. And I think it shows we've been stress testing Canada's resilience through that oil price shock. But that's the second stress test in 8 years after the financial crisis. And a lot of the resistance has come on the consumer side. So I think that calls into questions what should be the policy mix going forward. I think there's been globally over-reliance on monetary policy. I don't think we had as much reliance in Canada as elsewhere, but there's been quite a bit of reliance. And clearly, globally, we need to move that mix away from monetary policy, and I think that applies well as well in Canada.
Yeah, and we'll talk about monetary policy in a moment, but I just want to focus on fiscal policy right now. And David, you've sort of worked on this extensively in the past. What's your view on the current fiscal policy outlook for Canada? We've spoken to the finance minister this morning. We've spoken in detail about infrastructure. What are you looking to see there?
First, I want to start with a very important point, and that is, what is Canada's potential growth rate going forward? And that depends both on our labor force growth and on our productivity growth. We know our labor force growth is slowing down. It's coming down from close to 1% at the beginning of the century to something just barely positive by the time we get to the middle of the next decade.
Like most of the advanced countries in the world.
Exactly. And we're behind Japan, behind Europe, but nevertheless it's coming down. So in order to continue to grow without inflation, then we're going to have big productivity increases, and that is the enormous challenge. In fact, it's the challenge that we're addressing today at this conference. So at best, looking forward, if we could get back to the sort of 1% productivity growth that we had, which was not great, but is a lot better than what we've very recently experienced, then we're looking at a potential growth of 1.5%, 1.75%.
So talk to me in pragmatic terms then. What do we need to do to boost productivity? Is it a case of improving the infrastructure?
Right.
Are we hoping for some new
technology? So then we
technology?
come to fiscal policy. And fiscal policy, I think, has an extraordinarily important role to play. You just heard the finance minister talk about the investment in productivity-enhancing infrastructure, i.e. infrastructure that would raise the productivity of private investment and raise the productivity of Canadian workers. And that really is the challenge. We have an opportunity, as he talked about, with very low interest rates and a good balance sheet, that we, in fact, can go out and borrow at this point to make those investments, provided we focus those investments on those things that are going to raise productivity, either to move goods around, to move people around, to move ideas or move electrons around. Those things are really productivity enhancing for the private sector itself and for labor. So yes, we came late to beginning to move forward with those investments. 2012, 13, 14, when we had an opportunity, we actually didn't make the investments, but now we are making them. And so I think fiscal policy now is actually on the right track. It is appropriate to be borrowing to make those investments, provided the investments are aimed at raising the productivity of both the private capital and labor in the private sector.
Just a couple of points on the opportunity that I think there is on the productivity front, just to emphasize. If you think of places, I mean, we've been weak. The weak productivity story is a story that has been for many years in Canada. In fact, right now, if you look at it, we don't look that bad compared to the other G7 country. But
because the others have got so much worse.
Have fallen and joined us.
I think we want to set the bar higher than being the least worst.
So I think in terms of the opportunity, I mean, the fact that we had weak productivity, we have overburdened infrastructure, is actually is a problem. But it means we have clear places where we can do something, which is not something that is obvious in places like Switzerland or Japan even. I mean, so that makes that that's one key point. The other is that, I mean, David mentioned the fact that funding is very cheap, so that's an opportunity to do that kind of investment. The funding is cheap. It's also that there's a huge appetite in this low interest rate environment for investors to find places where they can find more opportunity to generate return. And infrastructure globally is an alternative that has a huge proposition for investors.
Do you see Canadian infrastructure as a very attractive market right now?
I don't have a specific view on Canadian infrastructure, and as the minister mentioned, I think we have an idea of the quantum of the measure that will be taken, but in terms of the actual implementation and details, that's gonna, and that matters for determining the exact opportunity. But there is clearly, at least in practice, there's clearly a lot of opportunities available. Last point I would make is to your point about if we could get productivity up by 1 percentage point. Like bringing productivity back to the last 50-year average would basically offset 2/3 of the aging population impact on Canada. So that's a big deal in terms of impact.
Absolutely. It's really important. I guess the other thing I would say is that those investments, those public investments in infrastructure, really ought to be structured in such a way as they are going to generate a measurable economic return. And so if indeed we make those investments in the public side, in roads or networks of some sort, or bridges or in ports, then we ought to make it in such a way that those investments yield a cash flow at the end. I.e., if we're going to build roads, we've got to put tolls on them so that, in fact, we can take that and sell it off. If we're going to invest in water, then we've got to do it in a structure that we can take those waterworks, just as they have in Britain, take those and monetize them in the end by inviting private capital in. That means that borrowing that we make today, we actually can come back in the future, either pay that down, or very importantly, we can keep on making those investments rather than the stop-start that we've had, which is particularly evident here in this city.
Yep. Final question on fiscal policy, Jean-Marie. The IMF has been calling for greater fiscal spending over the last couple of years, I think it's fair to say, and to sort of relieve some of the burden that's been placed on central banks around the world. Our view on this is quite clear, that there should have been a lot more fiscal spending over the last few years rather than this move towards austerity, but it's politically very difficult. Canada seems to have come around to this idea and is going to invest significantly in infrastructure this year. Put that in the global context for us. Is Canada at the forefront of this for the advanced economies? Is it sort of at the front of this curve, finally getting into investment in infrastructure?
Yes. I think I couldn't agree more with what David was saying. I think it is extremely important, not just in Canada, but elsewhere in the advanced world. Canada is in a bit of an ideal position in that it has a stock of net public debt which is very low compared to other advanced economies. So even the traditional sort of cop-out of saying, well, no, because markets are going to react negatively to our relaxing fiscal discipline is clearly an argument that has doesn't have much legs in this part of the world. But I would say it is a more general problem in advanced economies. There has been a tendency to cut capital spending and infrastructure spending in recent years because that's the easiest thing to cut when you have to do fiscal adjustment. And the results are there to be seen. The conditions of infrastructure in the United States are what they are. Many European countries are struggling with the refugee crisis. Part of the problem is an infrastructure problem of getting these people housing and training and all that. And more generally, you have in many advanced economies a lot of slack. It's not just that infrastructure investment raises productivity, which is, of course, super important over the medium term, but you also have a lot of unemployed resources. You have demand in the euro area, which is extremely weak. So you have a double bonus from this type of spending, which comes from boosting economic activity, boosting demand in the short run, but also providing for a higher potential output, as we say, so higher growth over the medium term.
Yeah, okay. So moving on to a different policy now, trade policy, and the Trans-Pacific Partnership. And we'll be talking about it extensively later on today on a panel, but I just want to get your views on this and what its impact could be on Canada. Is this as big an opportunity that is currently just sitting on the table and we're waiting for everyone to ratify it? Will that make a significant difference to Canada? I mean, we've been talking for, it seems like several decades now, about Canada needing to move away from its reliance on the US towards Asia and Europe and Latin America. Will this help that, or is it just, will it move the needle?
I think it's important, just the numbers here. 94% of our trade in TPP countries is with the NAFTA group. And so moving from NAFTA to TPP really doesn't add a lot. The big add for Canada is Japan. And that's why it's very important, really, for Canada, because of that missing 7%, 4.5 points are Japan.
Right.
And the opportunities are really there. So I think it really is important, and we just put out our semi-annual report, and we've argued very important for Canada to say we're going to ratify. Obviously, if the United States doesn't ratify, the thing is dead. And then we have to move very directly to do something with Japan, because
right.
that's a major trading partner with whom
right.
we don't have an agreement.
So if TPP is not ratified by the US, and it's definitely up in the air, it's an election year, it's difficult to talk about trade there, what would the next step be for Canada? You think Japan is so important that it should negotiate a bilateral deal with Japan? I mean, it's the third biggest economy in the world.
It's our third biggest trading partner.
Right.
Right. So yes, I think that's extraordinarily important, number one. Number two, we have to decide how we're going to move with China. So those are the two big ones that are sitting there. Mm-hmm. China's already our second biggest trading partner.
Jean, you were going to say something there?
I was just making the obvious bigger point, which is if TPP fails, I mean, this is a major issue in the kind of deglobalization risk that we're facing. And Canada being an open economy, relying a lot on, it's not only about the access to Japan, which is very important, but it's more being the global landscape in terms of trade that would be changing dramatically in my view. And part of the objective of these trade deals, like we did with Europe, is not necessarily about like access to market. It's really about like harmonizing regulation, clarifying the landscape for businesses, and rules of the engagement. So and it's being part of the global supply chain is a major issue. So even if it's 94% is already in NAFTA, once you bring Japan, it's not only Japan versus Canada, but it's Japan interacting with the rest of the world and being part of that supply chain.
I mean, unfortunately for us, being external trade being very important for us, unfortunately we face a world where protectionist forces are very strong. It's not just south of the border. It's not just in Europe. It is also in China. And so, yes, it's a very worrying thing, and hence it's really very important that the TPP move ahead for the reasons Jean said. And it's still, there's a risk that the Europeans won't ratify CETA.
Yeah. One of the opportunities that has come up already this morning is what's happened to the currency over the last few years. And people have talked about the boost to Canadian competitiveness and what that means for Canada's trade. What are the chances of a resurgent manufacturing industry in Canada, given that boost to competitiveness? Canada has suffered in the past from having such a strong currency. It was less competitive around the world. Is that a ray of light for Canada's manufacturers? Who wants to take it?
Well, look at it the other way around. We had the dollar which ran up from something in the order of 80 cents to something close to parity as resource prices boomed, right? We're kind of back now to it, maybe slightly below, but we're kind of back to the level that one might have thought of as normal, given Canadian production prices relative to U.S. production prices. So yeah, I think that it's going to happen. But it will be slow. We can't expect the impact of getting back to a more normal trading range for our currency to happen quickly.
Yeah, and that's an interesting way of putting it, a more normal way. And so this manufacturing story, just to focus on that for a moment, there's been a rise in populism across the world over the last year or two. We've seen what's happening in the US presidential election. Across Europe, there's been a wave of populist parties gaining power. And a lot of their support and popularity comes from promising a return to the normal, whatever we enjoyed in the past, where there was a lot more manufacturing jobs in these advanced economies. Is it realistic to expect a return to that? Jean-Marie, you've written about the sort of industrial outlook around the world. Can you actually recreate those jobs anymore, or are they gone?
No, I think, so I would say on the positive side, in terms of location of manufacturing, the fact that a lot of manufacturing activities that used to be very labor intensive, textiles, have now shifted to being much more capital intensive than they used to be.
Yeah.
For that reason, from the perspective of firms' geographical location, you have now less of a bias away from advanced economies because the relative importance of labor costs, which were a big deal in a world where the share of labor in manufacturing was important, are a much smaller deal now. This implies that you have seen some manufacturing moving back to the United States, but I think part is clearly the exchange rate, but part is this shift in the composition of the inputs that are used in manufacturing. But this very fact that you now have less labor input in manufacturing implies that from a jobs perspective, you cannot expect miracles. It's a small part of the economy. It's typically in the 10, 15% of GDP range. It's very hard to expect miracles from unemployment perspective.
Right, so even if manufacturing were to enjoy a bit of a resurgence, it'd be jobs for robots, is that?
Well, I mean, you get returns and, you know, you need the people that produce the robots. So I'm not saying there is no impact on employment, and the fact that if you have a capital-intensive industry, it also means that the wage should be very high because the marginal product of workers is much higher.
Right.
So it is beneficial, but on a scale of the numbers of employed, that is not what is going to make the difference.
So you want to be at the forefront of the technological innovation that's happening, and maybe that's where the potential is for
that could help productivity, but I say we've seen, actually we were discussing earlier the weak recovery. The recovery has been very weak in GDP terms. In employment terms, it has actually been quite okay. Look at the growth in employment, the decline in unemployment in the United States. Just that productivity has been very weak.
Yeah, okay. I'm going to come to the audience for Q&A now in a moment, so get your questions ready. One final question, and you can answer this in one word if you like. Does Canada have a housing bubble?
Go ahead, Jean.
I think it won't be one word, it's going to be a couple of words, but quickly. We stressed Canada twice with big shocks. We were resilient. The resilience came from the consumer sector and the housing sector. I think part of it is we have easy monetary financial condition that has helped that to support that, which is a good thing. But monetary policy can only buy time. We've borrowed from the future in that respect. I think this is manageable, but it's clearly a constraint going forward. I don't think we can rely as much on the consumption and the housing sector as we have.
I think that's exactly the way to answer the question.
Right. I wasn't aware we had so many politicians on this panel. I didn't. All right, great. Well, now we've got a few minutes for questions from the audience. So if you have a question, just raise your hand, and we've got some roving mics out there, I think.
Thank you very much. Bruce Harbinson, Tech Canada, we're one of the sponsors here. You've outlined some great strategic points that I think most governments could take a cue from. I'm wondering what your thoughts are. We know in the private sector, strategy is one thing, execution is another. What about investment in leadership in order to be able to get us executing on some of these ideas? Any comments?
Great. I'm going to take one more question as well, and then we'll come to answer both of them. So there's one over here as well.
Thank you. Brett House from AlignVest. I wonder if you could speak more on what policy initiatives government could take on job quality. We've seen a rebound in non-oil manufacturers' exports from central Canada at the same time as employment continues to dive. And corollary to that is employment in service sector, wait staff, hospitality has gone up in a kind of equal fashion to the decline in manufacturing employment. So what can we do to address job quality in a meaningful way in the short and medium term? Obviously, education is a longer term response, but that takes a long time to take hold.
Right, okay. So the first question, leadership in the private sector in particular. What can people be doing? What should they be doing right now?
This is a tougher one for me, but other than agreeing that implementation is absolutely key, and it's not only about having the ideas, but it's having the leadership to implement it, and I live that actually every day now, even more than I used to. So, but in practice, in terms of what can be done, I mean, other than saying boilerplate things about making sure we have the right training in our schools and so on, I'm just going to agree with the premise here.
Yeah, it's not just training. I think part of it is our general attitude. We have been, in this country, pretty hostile to failure. And I think that's the big contrast between the climate here and the climate in the United States. And so part of what we need to recognize is that success and innovation involves failures along the way, and we can't penalize failures either socially or economically in the way we have tended to do historically. So that's not precisely leadership, but I would argue that's probably the most important climate change.
Right. So you want to, so you want to
That's
see.
the way to answer that question.
So do you want to see Canada's business leaders to be taking more risk, or at least creating the environment where risk taking is more acceptable and encouraged?
Among their employees, and I think in general, we need to look upon those failures as being steps along the way. Don't make the same mistake twice. That's really stupid. But making a new mistake, trying to do something new and innovative, that's got to happen if you're actually going to succeed.
So fail fast and fail forward, I think, is what they say in Silicon Valley. Great. And the second question on the quality of jobs being created, what are your views there?
Well, I agree with Brett. I mean, I think the service sector jobs, which we've looked down on, are not necessarily such bad jobs. The tourism sector is an important sector, and indeed, done well, those can be very rewarding jobs. And so we have to think of those as being skilled jobs rather than the sort of thing that we just let students do in the summertime. We have to think of that. And that will make Canada a much more attractive place for people to come.
Yeah, I think when we talk about productivity enhancing measures, I mean, clearly, traditionally manufacturing was a big source of productivity growth, but size-wise, it is clear that aggregate growth has to be driven by higher productivity in services. There is plenty of scope for that, plenty of diversity within the structure of services. Services are becoming also more tradable internationally. So I think we shouldn't stick to the idea that the only good jobs are jobs associated with manufacturing activity, also from a productivity growth perspective, from a high wage perspective.
Right. Okay, we're unfortunately running out of time, and I could continue this conversation for at least another hour. I just want to wrap up with a final question for each of you, and it's to just be more forward-looking. If we're sitting on this stage a year from now, 2 years from now, what do you think the burning issues that we would be talking about then would be? Let's assume oil stays above $50 a barrel, and that's not as big a story. What does Canada look like a year or two from now, and what are the main areas that we'll all be talking about?
I think we'll be talking about exactly the same issues we've been talking about today.
I hope not.
These are ongoing issues.
Mm-hmm.
I hope we will be talking about the same issues, and we will not be talking about a much nastier external environment. I am personally, and also the IMF as an institution, very concerned about inward-looking political pressures and policies in a number of countries. There are big risks out there. We have a big referendum in the UK on an issue that could well reverberate in Europe to a much larger extent than just the presence or not of the UK in the European Union. So I do hope we'll have an external environment that is as conducive to a stronger recovery as it can be, and not a much nastier one.
Right. Sean?
I hope we're going to have continued to build on the resilience domestically, but I think at the end of the day, the external story will be the key one, and I think we're looking at a world that is a bit bifurcated, both in terms of geopolitics and politics. I mean, it might be a bit of a different discussion depending on what happens in November. And we also have, as I said, I think we're struggling with this recovery that has longer to go, and then things get some of the risk materializing. And so I think it looks a bit bifurcated, but I think it's going to be driven by external. In 2 years, we're going to be talking about external factors.
So I think that's one of several coded references we're going to have to a possible President Trump throughout the day. So if I'm to sum up, I think there's a very clear theme coming through from all three of you, which is that domestically, you think Canada is on the right track, and the biggest risk to the economy over the next couple of years is an external shock, and that's really out of Canada's hands. So a thumbs up, I think, is the report card from each of you, it seems. All right, can you please join me in thanking our three guests?